Signs of a zombified housing market being brought back to life? Or is it just the dawn of the dead market? A new report says that home prices continued their pattern of declines and mortgage rates rise as inflation takes a bite out of affordability, and iBuyers are racking up major losses. However, spring may bring new hope as pending home sales blow past expectations and home buying season may be off to an early start. All of that plus, MV Realty is being accused of having a shameful business model, and the CFPB steps in to help military families. And what is Amazon doing that helps employees buy a home? Join us for a thriller of the show, This Week in Real Estate. Yeah! Welcome, everyone. Thank you so much for joining us. My name's Ray. I'm joined by my co-host, Dan. Say hi, Dan.
Hi, Dan.
And we are the Bearded Men of Real Estate, hosting this little show called This Week in Real Estate. I am going to check to make sure we're actually live. So this was really fun. It is showing streaming. Okay, good.
Yeah.
As soon as I hit the go button, it was like, oh, are you sure you want to go live on these places and ask me some questions? I'm like, I don't know. What is it doing? So I had to double check. It looks like we are not live on LinkedIn for whatever reason today. LinkedIn's having some issues with it, but yeah.
We should be live on YouTube if you're there on YouTube. I know Dusty's already waiting. She's first today. So if you're there.
That's right. I'll go ahead and get to that comment. What's up, Dusty? You did make it first. And as you know, those who followed the show for many a years, this is our 221st show. Wow. So thank you guys for dropping by. We did change the format just a couple of weeks ago. And we cover a whole bunch of news articles right at the start of the show. Today we have more than ever. So I'm super excited about that. And I wanted to be sure to let you know that as we are going through the articles, when you comment about one of those articles on YouTube, Facebook, or even if you drop a comment into Clubhouse, we're going to try to get to that comment as we transition to the next article. So feel free to let your comments pile on. And that being said, I think it's time that we talk about what the heck is going on with pending home sales, Dan. U.S. pending home sales surge in January despite looming affordability issues. The housing market has experienced significant increase in pending home sales in January of 2023. The data from the National Association of Realtors shows that pending home sales rose 8.1% from December to January, making it the largest monthly increase since June of 2020. The rise in sales was mainly due to the drop in mortgage rates from the recent highs of over 7%, which made homes more affordable for buyers. All regions of the U.S. reported a month-to-month increase in pending home sales, and the West is seeing the largest rise due to lower prices. However, the increase in rates in January hit affordability, with the monthly payment on a median home price now 45% higher than it was at the same time last year. As a result, many buyers are holding off on the market to see if rates will drop, or if home prices will go down. NAR anticipates the number of home sales will drop this year. Although the economy is predicted to continue adding jobs throughout the year, the 30-year fixed mortgage rate is expected to drop steadily as an average of 6.1% in 2023 and 5.4% in 2024. Despite this, NAR predicts that the annual existing home sales will drop about 11% this year from last year before rising 18% in 2024. New home sales are projected to fall about 4% this year compared to last year before surging nearly 20% in 2024. Overall, the U.S. housing market remains somewhat volatile, with the impact of rising rates and home prices pushing many would-be buyers out of the market. While the lower mortgage rates have driven a boost in sales, affordability remains a key issue that's likely to impact the market for the coming months.
And by the way, Olivier commented, and he says that monthly increase is such a bad statistic. And we have to agree with that, because especially with how it's been the last 2 or 3 years, you have to go year over year. So that's where it really comes in. But, when you're trying to find a headline, you tend to go monthly, and that gives you a headline. But
and you do have to look at that monthly increase just so you can see what kind of trajectory you're on, because when you look at monthly increases month after month after month after month, then you can kind of see a little bit of trajectory. But yes, I totally agree. As a standalone number, it's a little out of whack.
And you can see trends and historically up, down, or so or whatnot. But he also says that and by the way, he's in Canada, I think outside of Montreal or Toronto. I always forget. He says we are down 30% year over year in February. So just like that, Ray.
Yeah.
Do we see a recession coming here in the United States? By the way, you guys, you got to smile. In case you forget, it's just going to be the whole show. I'm not going to take this off. But a modest recession. This is from Inman. A modest recession could put a lid on the 2023 home sales. The U.S. remains on track to fall into a modest recession during the second quarter, which could put a damper on a promising start to the spring home buying season, but set the stage for mortgage rates to ease and for home sales to rebound. I don't know why I said it that way. Rebound in 2024, economists at mortgage giant Fannie Mae predict. Home sales started out the year on a relative high note thanks to mortgage rates retreating from 2022 highs. But rates have since reversed course following a strong February 3rd jobs report last week. And last week's consumer price index readout, which showed inflation cooling only slightly in January. But a recession still looms as, quote unquote, consumption continues to outpace income, a trend that is unsustainable long term. And that's from the Fannie Mae economists. And that's what they're predicting. I find this article, again, you can go to Inman to see this whole article, but I found this really interesting because consumption is part of, affordability. If people out there buying, they're not going to buy homes. The economists go on to say, we view a soft landing, though possible, as unlikely. Fundamentally, personal consumption remains at a level that is unsustainably high relative to incomes, pointing to eventual consumer spending retrenchment. And that it ends with Fannie Mae forecasters see rates for 30-year fixed rate mortgages dropping below 6% in the second half of the year. Good for my prediction. And continuing to fall to 5.1% by the end of 2024. It's a very specific prediction. Now, economists at the Mortgage Bankers Association are forecasting a more precipitous drop, with mortgage rates falling below 5% in the second half of 2024. So it's going to be interesting to watch those rates.
Mike V said modest is putting it modestly. He's joining us on Clubhouse and on YouTube there. Basically, the more consumers spend, the more they consume, then the higher the risk of the inflation. And I think what the Fed thought is that by raising these rates up, it would just kind of put a halt to that. And it just hasn't. And I think maybe that just shows some of the strength in the economy there.
And when did we cover it? A week or two ago when we talked about one of the articles had that consumer spending, on goods and services is way up, way more than expected. So
we did the CPI, the consumer price, the consumer sentiment index, the consumer sentiment index was up. So
CSI.
They were anticipating they would continue to spend, which is actually probably just going to make rates go even higher. Yikes. So home buyers beware, mortgage rates rise to nearly double last year's, adding hundreds of dollars to monthly cost. The rise in mortgage rates is a reflection of the economy's strength, tight labor market, and sticky inflation. Freddie Mac's chief economist, Sam Carter, noted that the economy continues to show strength and interest rates are repricing to account for the stronger than expected growth, tight labor market, and the threat of the sticky inflation. That was a quote from them. As the economy recovers from the pandemic-induced recession, there has been an increase in demand for goods and services, leading to a shortage of workers, which puts upward pressure on wages and prices and leading inflation. Despite fluctuations, mortgage rates have been on an upward trend since their peak in November. The current 15-year fixed rate mortgage is 5.76. That's almost double what it was a year ago, which could make home ownership less affordable for many. The National Association of Realtors reported that existing home sales dropped by 17.8%. That's the weakest year over year for home sales since 2014, and the largest decline since the crisis began in 2008. With high home prices and the added burden of higher mortgage rates, home buyers may find it more challenging to afford a home. Freddie Mac's chief economist suggests that home buyers can potentially save hundreds of thousands of dollars by checking on your car. No, that's just...
It sounded like a Geico commercial.
I know, it's so ingrained. Freddie Mac's chief economist suggests that home buyers can potentially save hundreds of dollars per month by taking the time to shop lenders and find better rates. According to Carter, our research shows that rate dispersion increases as mortgage rates trend up. This means that homebuyers can potentially save $600 to $1,200 annually by taking the time to shop among lenders and find the better rate. Homebuyers should not assume that all lenders offer the same rates and fees, and shopping around for the best deal can help them save money in the long run, which I think is something that most real estate agents tell people very carefully to avoid the whole RESPA accusations and such. But I mean, that's one of the things I tell all of our clients to do, is not only shop, but tell those lenders that you're shopping.
Let them know. Absolutely. Make them compete and let them know they're competing, and they're going to give you, because there are some lenders out there that will not cut corners for you, or will cut corners to save the money for them, not for you. So make sure you're challenging them for sure.
I want to get to this comment from Olivier. He said, spoke to someone in business around here last week, and last week's discretionary retail is taking a huge hit now. So that may be, even since the timing of this report, that stuff may be changing, because we are watching this market change quickly, and it's changing live.
It's changing really quickly.
Good comment from Dusty too. She said maybe people still need houses regardless of inflation.
Just a thought. She has just a thought.
Maybe people still need a place to live, possibly.
Yeah. Not to point out the obvious, but but I wonder, Ray, with all this, I wonder what's going to happen to home purchase applications.
That's a great question, Dan. I'm glad you.
It's almost like we know what the next article is. It's so weird.
It's a good prediction.
Home purchase plunge to 28-year low as mortgage rates jump. There you go. This is from MSNBC. Mortgage rates moved higher last week, again pushing buyers back to the sidelines just as the spring housing market is supposed to be heating up. We have a story coming up that says the market may be heating up earlier than expected. So this is interesting. Mortgage applications to purchase a home dropped 6% last week compared with the previous week, according to the Mortgage Bankers Association's seasonally adjusted index. Volume was 44% lower than the same week 1 year ago and is now sitting at a 28-year low. It's pretty devastating. This, as the average contract interest rate for a 30-year fixed rate mortgage increased to 6.71% from 6.62%. That is the highest rate since November of last year. Mortgage rates have moved 50 basis points higher in just the past month. Last February, rates were in the 4% range. And then the article concludes with, and again, if you want more details on this, this is at MSNBC. This is a quote from our favorite MBA economist, Joel Kahn. There you go. You get to do it. Data on inflation, employment, and economic activity have signaled that inflation may not be cooling as quickly as anticipated, which continues to put upward pressure on rates. So we're going to have to watch that. We don't have any predictions of rates being pushed up or any announcements coming up, do we? I don't think so.
I think March 21st through 22nd is the next time they're getting together. I think that's when we hear it. So usually on a Wednesday, right as our show ends, is when we normally hear it.
So in a couple more weeks, 3 more weeks, we'll have that for you after our show.
Olivier says more and more are predicting another increase. Yeah, I think so too. Yeah. And that's in part because of what we're talking about, the additional consumer spending, the consumer sentiment index. I think that's what it was called. CSS consumer. Anyway, it was off a week ago. We talked about that on the show. And that just kind of leads us to what's going to happen now this year in housing. So Goldman Sachs has a dubious prediction. Goldman Sachs predicts a double-digit housing price decline in 4 U.S. cities due to oversupply and poor affordability. According to Goldman Sachs, an analyst, the surge in demand for housing during the COVID-19 pandemic, coupled with the low inventory levels and historic low interest rates, caused prices to skyrocket in certain areas. However, as the pandemic eases, I said it, I've been saying pandy this whole time. As it eases, the interest rates rise and the housing markets begin to cool. Furthermore, cities like Austin, Seattle, Phoenix, San Francisco that experienced significant increase in demand and prices during the pandemic are expected to see major decline in home prices in the next few years as an increase of available homes surpasses demand. That's my only question. Like, where are they getting the increase of available homes surpassing demand? But I digress. The analysts attribute the predicted decline in these four cities to local challenges such as poor levels of affordability, Pandy-related distortions, and a high concentration of employment in technology industry. The last point is particularly relevant for Seattle and San Francisco, which are home to major tech firms, many of which have conducted layoffs in response to the worsening economic conditions. Goldman Sachs is also predicts a national decline in home prices of 6.1% this year, as the housing correction, quote unquote, plays out. While the high mortgage rates have pushed many prospective buyers to the sidelines, mortgage rates have cooled slightly since peaking above 7% last fall. However, some recent troubling inflation data, which we were just talking about, has exacerbated the fears that the Federal Reserve will hike the benchmark interest rate higher than expected. Overall, housing inventories will still run below normal levels, which has kept prices from experiencing a more significant collapse. Despite this, the decline in home sales is nearing a bottom, but the price plunge is expected to continue for months. Let me read that last sentence one more time. Despite all this, the decline in home sales is nearing the bottom, but the price plunge is expected to continue for months. Is Goldman Sachs right? Are they wrong?
I mean, the next one, we'll tease it. The next article we have says, it kind of says otherwise, but it's interesting to see, because this article that I'm about to read is going to spur a lot of clickbaity headlines. But when you read the numbers, it's not. It's just another. What is it now, Ray? It's not home price gains slow. It's price increases slow, or something, or ease or something. Soften.
Right. Yeah. Soften. It's a softening home price increase. Still, home price is going up, but they're softening now. Dusty said, I don't know. Inventory is currently shrinking in Phoenix. So inventory, there's not additional inventory hitting the market like everyone says. It's actually getting, where'd they go? She said, it is more in line with our seasonal norm. We're just going back to normal. Interesting. I will take this second also to celebrate that Matt LaMarche has joined us on the show today. He said, sorry I'm late. He was saving the world. So we appreciate you saving the world, Matt.
Save the world, buddy. We appreciate you.
Yeah. Dan had a visitor. Are you ready, Dan?
Yeah, I'm good. I just, I got a lot going on, so I had to run off camera real quick.
Okay. Well, tell us about the S&P Corelogic Case-Shiller Index, if you don't mind, please.
Now, this is something I've been waiting on, and I'm sure Ray's been waiting on, as well as other realtors, other industry professionals, because this is the report for the fourth quarter of last year. And the title reads, and this is actually from SP Global. So S&P Corelogic Case-Shiller Index decline continued in December. Dun, dun, dun. So it's titled New York, February 28th, 2023. S&P Dow Jones Indices today released the latest results for the S&P Corelogic Case-Shiller Indices, the leading measure of U.S. home prices. Data released today for December 2022 show that home price gains continued to drop across the United States, with declining prices reported in the San Francisco and Seattle markets. You want me to read that again? Data released today for December 2022 show that home price gains continued to drop. Doesn't make it. Home price gains continue to drop. So remember that as I read through this. I'm going to try to get through this quickly. If you want, the report is out there. Because it is very detailed. They give you year over year, which I'm going to hit, month over month, and then an analysis, which goes into depth. I'm just going to hit a little quote from that. So year over year, the S&P Corelogic U.S. National Home Price NSA Index, covering all 9 U.S. Census divisions, reported a 5.8% annual gain in December, down from 7.6% in the previous month. So still up 5.8%, right? Just not as much. The 10-city composite annual increase came in at 4.4%, down from 6.3% in the previous month. The 20-city composite posted a 4.6% year-over-year gain, down from 6.8% the previous month. So tons of gains all over the place. They're just gaining less. Miami, Tampa, and Atlanta, I combined all of those words into one, reported the highest year-over-year gains among the 20 cities in December. Miami led the way with a 15.9% year-over-year price increase, followed by Tampa in second with a 13.9% increase, and Atlanta in third with a 10.4% increase. All 20, and remember, they're talking about prices. All 20 cities reported lower prices in the year ending December 2022 versus the year ending November 2022. So that's actually a good thing, in my opinion, for things to slow a little bit. And remember, prices are different than values. Okay. So if you see large drops in prices, that doesn't mean that the values are dipping that much. So month over month, before seasonal adjustment, the U.S. National Index posted a 0.8% month over month decrease in December, while the 10 city and 20 city composites posted a decrease of 0.8 and 0.9% respectively. After seasonal adjustment, the U.S. National Index posted a month over month decrease of 0.3%. Of negative 0.3%, and the 10 and 20 city composites posted negative 0.4 and negative 0.5% respectively. In December, all cities reported declines both before and after seasonal adjustments. So that's what I've been seeing and predicting is about a 0.5 point drop over the next year per month. And then a quick quote from Craig Lazar, and then we can go to comments or we can go to Ray. He says, he is the managing director of S&P, by the way. The cooling in home prices that began in June 2022, predicted 3 months before that by us here on the real estate this week in real estate, by the way.
It's true.
We predicted it in March and April of last year, so we were before that. The cooling in home prices that began in June 2022 continued through year end, as December marked the 6th consecutive month of declines for our national composite index. He goes on to say the national composite declined by 0.8% in December and now stands at 4.4% below its June peak. For 2022 as a whole, the national composite rose by 5.8%, the 15th best performance in our 35-year history, although obviously well below 2021's record of a 18.9% gain. We could record similar observations in the 10 and 20 city composites. So
it's so confusing. I can't tell if the market is getting better or is it getting worse. Is it heating up? Early signs point to a competitive spring buying season, which would mean the market is crazy. Heating up. According to the article, this was on Inman, the U.S. home sales are picking up as buyers get an early start to the busiest and most competitive season of the year. Zillow's data showed that newly pending listings in January fell 20% from the previous year, but remained about the same level as January in 2020. The report indicates that buyers are taking advantage of the less frenzied market to make well-informed offers, while sellers are benefiting from the low inventory environment. In the words of Ryan Platsky, he's a realtor of Heggeson Platsky Real Estate Group in Minneapolis. Is it Minneapolis or Minneapolis? Minneapolis.
Yeah.
You won't see I don't know why I said Minneapolis. It's like realtor. You won't see,
you're adding things.
You won't see the 10, he says, this is Ryan Platsky. You won't see the 10 offers, all cash, non-contingent, etc. But you will see one or maybe 3 offers that are usually on the first or second weekend, where you'll be able to select which one to go forward with and comfortably make a decision. The report shows that while buyers are slowly returning to the market, sellers are more reluctant to list their homes. Zillow's data revealed that only 230,000 new listings came on the market in January. That's the lowest number since 2018, when a company began tracking the metric. Oh, well, that's not that long ago. The reluctance to list may be due to the mortgage rate hikes throughout 2022. Those put pressure on sellers to avoid listing their homes unless transacting was unavoidable. Nick Paynes, an agent for Remax Alliance in the Denver area, said that he expects the competitive spring buying season, with mortgage rates now hovering around 6% and the inventory expected to stay low. He adds that it's going to be an interesting spring market. I agree with Nick. If you know
Yeah.
Nick, be sure to tag Nick in the comments there. It
I
is
think it's
going to be
weirdly
interesting.
competitive.
Well, is the closer that it gets to 6 and under, if rates stay under 6
Yeah,
for
sure.
longer, it's going to be very competitive. I think
Which
there's
I don't
going
know
to be
if
a
we
lot of
want that.
buyers entering the market.
Do we want that right now? Do we want it to go under 6 with inventory still lagging?
I mean, it's going to really depend on exactly what's happening with inventory. So that's the key there. If there's more inventory, it's going to be great. If there's less inventory, then how can you say with a limited amount of inventory and buyers entering the market just under 6%, how can home prices decline? They won't decline. They just will go up slower. There's no way they could decline because of the lack of inventory. And there's no solution for inventory in any of these articles that we've covered, any of the studies that we've looked at, any of the decisions that the government has made. There has been no solution for the lack of inventory.
No, I mean, we know that builders are feeling a little better about the market and trying to keep up. But just as you said it, the government's not doing anything for sellers, but they are doing something for FHA buyers.
They are doing something. Let's help the opposite side of the coin. Let's really work on getting more buyers the ability to buy more.
Let's add a 50th incentive for people to buy a home and still do not consider any incentives for sellers. Let's just keep doing that. Okay, so the real estate industry welcomes FHA premium cuts with caveats. So there's an asterisk attached to it. And this is from Inman if you want to go see the whole article. Real estate industry trade groups are welcoming a decision by the Biden administration to lower annual FHA mortgage insurance premiums on new loans by nearly 40%. There's one key word in there that I just said. I'm not going to give it away, though. But the premium reductions, which are expected to save borrowers $678 million a year, it's a lot of money, don't apply to existing loans or let homeowners stop paying for FHA mortgage insurance altogether once they've built up enough equity, as some housing advocates had hoped. So it's just new loans. Last fall, real estate industry trade associations joined with fair housing and civil rights groups under the umbrella of the Black Homeownership Collaborative to ask the Department of Housing and Urban Development to not only slash FHA premiums, but to drop quote unquote life of loan requirements that force most FHA borrowers to continue paying annual premiums until their loans are paid. The 30 basis point reduction in the FHA annual mortgage insurance premium announced by the administration Wednesday applies only to new loans. Borrowers taking out new loans endorsed on or after March 20th, so that's in the next few weeks, will pay annual FHA premiums equal to 0.55% of their outstanding loan balances rather than 0.85%. So still, the premium reduction announced Wednesday at an event at Bowie State University, where Vice President Kamala Harris joined HUD Secretary Marcia Fudge. I've never read her name, so that's funny. HUD Secretary Marcia Fudge. It sounds like a cartoon character, doesn't it? That's so weird. It will benefit about 850,000. It's kind of where my brain's going. So this is the kind of frustrating part. Now, this is cool. It's a good change for people, and it's going to benefit about 850,000 new borrowers a year with an initial average savings of $800. So that's not necessarily a bad thing because,
it's not bad. I mean, I like lower government fees for sure,
right, exactly.
But it still doesn't do anything to solve the inventory crisis that we're all going through.
It doesn't do anything to help. And we've been saying this, me specifically, for 5 or 6 years on this show. Incentivize sellers, do something to help sellers. That will, think about that. Think about how quickly we could solve this crisis because this inventory level is a crisis. It's really, really low. Think about how quickly we could solve it if we just came up with a few different ideas to incentivize sellers. And it would help flatten this market out. Then we could bring, it would curb inflation. It would bring rates down. It would settle everything out. It's just frustrating. So
boom, roasted.
Well,
Yeah.
surely, Dan, there's a better way.
So mad about
Better.com is back in the news.
Oh,
You'll
no.
be you'll be happy to note, Matt. Flexible financing. Better.com enables Amazon staff to pledge stock for down payments.
Great.
Amazon.com Incorporated has historically offered its employees less cash compensation than its big tech peers, and instead have focused on offering restricted stock units, RSUs, as a means of compensation. These shares vest over several years, and the longer the employee stays with Amazon, the more their current compensation depends on them. For some executives, shares make up more than half of their total income. However, over the last year, Amazon's share price has dropped by more than 35%, falling short of internal targets and leading to lower compensation. To mitigate this, Amazon has been guiding its employees to hold the stock longer and think like owners to experience an increase in price. The new arrangement with Better.com, which does not involve any financial agreement between the companies, is designed to provide flexibility to a workforce paid largely in company stock. Better.com's equity unlocker, the BEU, Better.com's equity unlocker product will enable employees to pledge stock for loans as down payments rather than having to sell the stock to raise the cash. However, to protect against a continued slide in Amazon's stock price, Better.com will charge a higher rate on employees' mortgages, depending on the down payment structure. The higher rates will range from 0.25 to 2.5% above the market rate. The new arrangement is likely to be particularly attractive to Amazon's employees, given the company's focus on offering restricted stock units as a form of compensation. By pledging stock instead of selling it, employees will be able to avoid triggering taxes and losing out on potential future gains. However, it's worth noting that there are risks involved with pledging stock for loans, and employees should carefully consider the terms of the loan agreement. Overall, the arrangement with Better.com is a creative solution that to the challenges faced by Amazon's workforce, and it's interesting to see if the companies will follow suit. It's taking out a loan against a portfolio or against a stock is not new.
No.
I don't know that this move is going to save Better. It does put them in the headlines again. It's an interesting strategy, but what percent of Amazon's employees are going to go through that? And then what are the caveats? What are the asterisks in this agreement with Better.com? And they're just trying to own a whole bunch of stock with Amazon.
Well, there's no financial agreement between the two companies. That's the first red flag I saw. And then Dusty says it
they're not. I guess they're not in partnership with each other in any way. So it's still like, hey, we're going to do this for you guys.
Right. Don't put anything in writing, but like Dusty says, she says this sounds like a long-term plan to strip people of their wealth unknowingly.
But when you say, Dusty, that investing in real estate is wealth, so they're owning real estate, they're just trading the Amazon stock for it.
I don't know. I'm willing to bet that there's something in the fine print that gives stock back to either Better or Amazon.
Mike V says, on a listing of mine in December, the buyer had to sell a bunch of Tesla stock at about $120 a share for the down payment. 6 weeks later, it hit $215. Oh,
I mean, that's almost double.
Oh, it's painful. Oof. That's painful. Yeah, Dusty makes the point that everyone that knows anything about the stock market says you should play long term.
Yeah. But housing is long term. I think that's the point Ray was making. And then Dusty also says, not when you're also paying higher interest rate and giving up your retirement savings. I don't know.
Matt Lamarche says they have the best PR company. Are you talking about Better, the lending company? You think they have a better PR company? Yeah,
they have the betterest PR company on the planet.
I don't know. It's an interesting strategy. The reason why we're talking about it is because Better.com has been in the news so much lately. You might remember not long ago, they fired a whole bunch of people on Zoom. Amazon has also been in the news for their employee practices. They are changing out a lot of the workforce that they are hiring with robots. But they're also saying that they're worried that they can't find enough employees in the future, and that's why they're going towards a lot of automation. So they've both been in the news about what's happening with their workforces lately. So maybe this will stem the tide.
You know who might be in a little bit of hot water by the CFPB?
Your cat?
No, cats are fine.
Oh, okay.
No, the cats are good. RMK Financial, which I've never heard of. But the CFPB shuts down mortgage loan business of RMK Financial for repeat offenses against military families. That's a bad headline right there. They didn't just do it once; they've done it more than once. And this is from
Veterans United. Better watch out.
This is from consumerfinance.gov. If you want that one. Now, this one starts off with Washington D.C. I always love when articles start with that. Washington D.C. February 28th, 2028. Yeah, or 2000. I don't even know what year. 2023. Today, the Consumer Financial Protection Bureau, or CFPB, permanently banned RMK Financial Corporation, which does business as Majestic Home Loans. I'm curious. Have any of you guys?
I have heard of Majestic Home Loans. I have not heard of the RMKV or whatever, but I have heard of Majestic Home Loans.
I have not either. I haven't heard of either, but I'm curious if anyone out there has worked with either of them, Majestic Home Loans or RMK. But they do business as Majestic Home Loans from the mortgage lending industry by they've banned them by prohibiting RMK from engaging in any mortgage lending activities or receiving remuneration, which means money for services. I had to look that up from mortgage lending. In 2015, I was reading it. I'm all, ooh, a new word, remuneration. In 2015, the CFPB issued an agency order against RMK. So this is not their first offense. This is not their first rodeo. An agency order against them for, among other things, sending advertisements to military families that led the recipients to believe the company was affiliated with the United States government. Despite the 2015 order's prohibition on these and other actions, the company engaged in a series of repeat offenses, including disseminating millions of mortgage advertisements to military families that deceptively used fake U.S. Department of Veterans Affairs seals, the Federal Housing Administration's logo, and other language or design elements to falsely imply that RMK was affiliated with the government. In addition to the ban,
Veterans United.
Dude. In addition to the ban, RMK will also pay a $1 million penalty that would be deposited into the CFPB's Victims Relief Fund. This is a quote from the CFPB Director Rohit Chopra. Even after the 2015 law enforcement order, RMK continued to lie to military families by falsely implying government endorsements of its home loans. That's so crazy to me. He goes on to say, she, I'm not sure, Rohit goes on to say, our actions reflect our commitment to weed out repeat offenders, and we are shutting down this outfit for good.
Woo. There's another outfit out there, and I'm not going to name names, but I've had several military people tell me, well, I have to go through this lender because they're for veterans. And I'm like, no. Everybody can do that. It's like, well, I got to get my veteran letter from them. I'm like, no. That's not how this works. And then they trap people in with a low rate promise, a low down payment promise, no fees, all this other stuff. And then the first thing they do when they see that the appraisal comes back and it's a little higher than where they are, is they're like, oh, well, that's good because your buyer has more closing costs than anticipated. So we're going to raise the price to that appraised value to cover additional closing costs for your client that it wasn't there initially, but now it's there. Yeah.
Magically.
And then if they can't do that because they run into a federal rule or regulation pointed out by, say, an agent, then instead they'll say, well, there's still money left. Then there's like $1,000 and somebody's got to come up with it. It can't be paid for by the veteran this time. And yeah, so I'm just saying, I'm not going to name names, but there's another company out there that should, I think, go through the same process as the RMKV people.
RMK. Yeah, I mean, it's good they're cracking down on it. It's a good sign that someone is out there protecting consumers, protecting military families specifically for this instance.
Yeah. I've always worried whenever they come to me and they're like, we have to use this person because, and I'm like, I can, I don't want to get in trouble for saying anything negative about a particular
Right.
lender, but that lender is terrible. And no, you
Right.
don't.
Yeah.
Because the
It
last
just,
thing we want are lawsuits. And speaking of lawsuits, MV Realty, they're back in the news. MV Realty is a U.S.-based real estate brokerage. It's been hit with the fourth lawsuit by a state attorney general, this time from Ohio. MV Realty is under investigation by several state regulators for its homeowner benefit agreement, quote unquote, which the
like
company
a
has
ZZ
been
Top song, the Legulator.
regulators. That's true. The homeowner benefit agreement, which has been in the company's been offering since 2018. The agreements offer cash to impoverished homeowners in exchange for a 40-year contract to list their home and lien on their property to secure MV's real estate commission. If a homeowner decides to sell their home anytime in the next 40 years, they're required to list their home with MV Realty as the transaction broker. The agreements bind any future heirs of the property, and if the homeowner defaults, MV Realty imposes a lien or a mortgage on the property for the amounts owed. The agreement also includes an arbitration clause that precludes the homeowner from participating in any class action litigation against MV Realty. The company currently operates in 33 states and has over 500 licensed agents. The Ohio Attorney General's office accused MV Realty of negotiating, quote, misleading and confusing real estate contracts that violate Ohio law and of illegally providing real estate services in the state. MV Realty has already been sued by Florida, Pennsylvania, and Massachusetts, and several other states are investigating the company's practices.
I'm
The
assuming more
American
time.
Land Yeah, probably. The American Land Title Association has applauded Ohio's suit, stating that agreements like MV Realty should be made unenforceable and prevented from being recorded in land records. Diane Toom, CEO of American Land Title Association, stated that, quote, a home often represents a consumer's largest financial investment and their property rights must be protected. Oh, man, I wish NAR would make a statement like that. MV Realty is also, just saying, MV Realty has also issued a
Shade.
warning from the Federal Communications Commission regarding its use of illegal robocall campaigns. The agency identified, oh my gosh, this number. Okay, Dan, I know you haven't read this article. I hope you haven't.
I
How
have
many
not.
calls do you think the agency identified blank calls made by MV Realty? How
Now,
many
is
calls?
this nationwide or just in Ohio? What are we?
I'm going to say it's nationwide.
Okay. Over, does it give a
Two,
period of
wait,
time?
two numbers specifically on the do not call list registry. So that's going to
Okay.
probably put it in better context.
So only them. I'm going to say it's in the millions.
How many?
I mean, 320 million people roughly in the country.
But how many people are on the do not call list that will be called by MV Realty in 4 states?
I have no idea, but I'm going to say it's in the million. 2 million, 3 million people?
2 million, 3 million. Anyone else want to make a guess? Mike V says billion. No,
Billion.
not a billion.
They're calling the world.
They called the entire world one time. Yeah. All right. So MV Realty has also been issued a warning from the Federal Communications Commission regarding the use of illegal robocall campaigns. The agency identified 11.9 million calls made by MV Realty to numbers on the do not call list registry.
Dude, that puts KW's number to shame, dude. What are you guys doing, KW?
Shame.
What are you
KW
doing?
was like, "Oh, we owe 40 million." What they paid? We owe 40 million. No big deal. Oh yeah, gosh.
MV's like, hold my beer.
Yeah. The FCC deemed these calls to be part of a, quote, apparent homeowner-focused robocall scam campaign. Homeowners have complained that they did not give consent to be called. Do not give consent. Do not have an established business relationship with MV Realty, and that the brokerage repeatedly called homeowners despite being asked to stop calling them in violation of FCC's telephone solicitation rules.
I mean, hopefully they got, a lot of money from this scam because they're going to need it to pay all these fees. They're going to go down. They're going to go down. And Ray mentioned in the article, more and more are coming out.
Now, the reason why we're covering this again is because we covered it in the past. And the last time we covered it, someone told me that the person that started it was like a reality TV
Something like
star.
that. Melissa, I think, knows Mara. I think she knows. Dude, Matt did the math on that. 450,000 a day.
Yeah.
But Melissa, I think, knows about these guys or something, because I remember she said when we brought this first up, when we first reported on this, whenever it was about Florida suing them, she was like, "Oh, there's going to be more lawsuits. They're sketchy everywhere."
This is really interesting. Who started MV Realty? All right, let me find this. I know I had this somewhere. Amanda Zachman. She was the founder / CEO and still a member of the executive team. She was on Big Brother. That's what it was.
There you go.
She was on Big Brother.
She's about to.
Matt
Big
Lamar
Brother's watching her apparently.
450,000 a day. Good grief. How many a minute?
I mean,
Do a minute.
Yeah, I love it.
I don't know if it's per
There's no
year.
time period.
11.9, I guess, since they started.
But it's been a few years. So, but either way, I mean, $450,000, 450,000 a day, 100,000 a day. I mean, that's crazy numbers. That is crazy numbers.
It's nuts.
Right. Speaking of crazy numbers.
Yeah, Dan.
We are about to rip through, and then we're going to deep dive this, because we're going to rip through how many articles, Ray? 6 or 7 articles about just losses on top of losses. And then we're going to deep dive this. So get your comments in. We're going to come back to it.
You know, Dan, my big question is how are these companies going to navigate this?
Man, I don't know. I just seems like month after month, we're just reporting loss after loss for these iBuyers. These are specifically this one. The first one that I'm about to cover is Compass, and then it's going to be iBuyer. But Compass revenue falls in Q4, but losses narrow despite a difficult year. All right. And all the ones I'm reading, the next 3 or 4 are all from Inman. So if you want to go see those, go over to Inman. Amid what it described as a quote unquote difficult year for real estate, Compass on Tuesday revealed that its revenue dropped 31%. And by the way, that's not the biggest drop that we're going to report in these next few articles. Its revenue dropped 31% in the fourth quarter of 2022, though the company did manage to lessen its losses somewhat. Okay. In a newly published earnings report, Compass announced that between October and December of last year, it brought in $1.11 billion in revenue. That's down from $1.6 billion during the same period in 2021, which was kind of expected. I mean, it was just a hot market in late 2020 and 2021. The dip was due to a 25% decline in transactions, which in turn was attributable to lower industry-wide transactions, the company said in a report. Compass also suffered a net loss of, this is just making me, $158 million. Okay, Ray, do you think that's for the year? Compass also suffered a net loss of $158 million during what time period, Ray?
Yeah, that's got to be a year.
During the fourth quarter. But wait, that's an improvement.
Oh my gosh.
That's an improvement compared to the $175 million loss the company suffered during the final 3 months of 2021. So there you go. The report notes that about $82 million of the loss in the final 3 months of 2022 was due to expenses from stock-based compensation and to depreciation from amortization. So, Ray,
so they're not real losses, is what they're saying.
That's what they're trying to say. But we noticed this, or we noted this on our show, not only for this company, but for other ones. Remember when Compass was buying and offering large real estate teams the moon to come over to Compass?
Yeah.
Well, now it's time to pay the Pied Piper, because they note that 82 million of that of the losses was from expenses from stock-based compensation. Remember, and they were offering the moon, and now it's time to pay up.
Dun dun dun. Wait, hang on. I literally, whenever you made that sound effect earlier, I hit that button.
It was good. It was a little more on time, but yeah.
But they're not the only company in trouble. I mean, this Q4 earnings report's going to go deep. Let's talk about EXP. So EXP World Holdings struggles in a Q4 amid a changing real estate market, but remains optimistic for the long term. And this is a super long article on Inman that we've summarized here. The article reports that EXP World Holdings, I don't know what gets it. The article reports that EXP World Holdings, a cloud-based real estate company, experienced a decline in revenue and profitability during the fourth quarter of 2022 due to volatile housing market. The company's revenue fell 13% year over year, $933 million, to a net loss of $7.2 million. That's like nothing compared to some of these other companies.
Yeah.
During the 3 months ending December 31. Those losses were attributed to the decrease in closed transactions and sales volume, which declined by 13% and 16% year over year, respectively. Despite the changing market conditions, EXP reported that the total agent count increased by 21% to 86,203. The company's full year results were solid, with revenue increasing 22% from 2021 to $4.6 billion, and EXP agents closing 511,000 transactions, $187 billion worth of real estate. CEO Glenn Sanford struck an optimistic tone about the company's overall position within the market and pointed to the ability to weather a shifting market. He said, quote, "Our model was designed to withstand varying market conditions, which uniquely positions us to continue investing in the agent experience in a down market. In turn, we maximize the long-term growth and profitability." During the company's earnings call, Sanford and CEO Jeff Whiteside struck a bullish tone about the EXP's long-term prospects, citing the brokerage's Net Promoter Score, NPS, of 73 as proof of the company's recent improvements, which include the launch of Revenues, EXP Luxury, and other Success magazine initiatives. It says Success Initiatives. I just threw a magazine so you guys know what I'm talking about. The executives believe that EXP is a prime financial position to continue investing in its agents and technology, while the company expects 2023 to mirror 2022 in terms of headwinds. Sanford and Whiteside stated that EXP is well positioned with $100 million in cash flow and no debt. So EXP is also losing money in Q4, but it's not nearly what some of the other companies were, and that's, I mean, it's likely due to a lot of the decisions they made regarding finances.
Yeah, and they made that decision kind of early on, but I feel like that's a pretty positive report.
Yeah, it's not bad. I mean, it could be a lot worse. I mean, all you have to do is ask iBuyers. Ask iBuyers is what I'll say.
Yeah, this one is not so good. So this one isn't necessarily about losses. This is Offerpad. And again, from Inman, Offerpad is cutting more jobs in conjunction with the $90 million raise. So what does that mean? As sometimes happens when money-losing companies raise funds. That's a weird dichotomy to me. When money-losing companies raise funds. Hey, I know we're losing money, but can you give us some more, please, so we can spend it on ourselves? I don't know. It turns out Offerpad's plan to raise $90 million in a private placement with existing investors will also entail some painful cost cutting in the form of layoffs. So they're trying to raise money and then they're going to cut some jobs. In announcing the new funding Wednesday, the struggling iBuyer made no mention that it was also laying off employees. But at least 4 Offerpad employees, including a product manager and 3 software engineers, posted public notices on LinkedIn Wednesday that they'd been laid off and were looking for work. This is a quote from senior software engineer Christopher Strawn. He posted on LinkedIn. He said, "Along with many others at Offerpad that were laid off today, I'm officially in the market for a role and would appreciate your support." It goes on to say, an Offerpad spokesperson confirmed that the company has laid off an unspecified number of employees, with more details coming on the company's fourth quarter earnings call on February 22nd.
I'm glad you mentioned that earnings call, Dan. Hang on. Yeah, I've been chatting with Matt in the comments. He's trying to do some calculations. I was providing the numbers, but
Yes.
let's talk a little more about Offerpad. Speaking of quarterly numbers, Offerpad lost $24,000 in Q4
Total?
on every home that it sold.
Wait, you need to do the Price is Right one.
Yeah, wait. Offerpad lost $24,000 on every home that it sold in Q4. That's very appropriate. Very appropriate.
Every home.
Yeah, so they sold more than 100,000 homes last year for the first time in company history and posted a record $121 million in fourth quarter losses. The losses continue to mount for the iPioneer Offerpad as the company sells off homes at a loss as acquired before rising mortgage rates cooled the sales in many markets.
Are they
Offerpad
really
said
Pioneer?
Wednesday. I mean, I think they were before the other iBuyers.
They were.
Offerpad said Wednesday that it sold over 10,000 homes last year for the first time in company. 10,000. I think it's 10,000. I'm sorry. I said 100,000 earlier. It only sold 10,000 homes last year for the first time in company history, but posted a record of $121 million fourth quarter loss.
Oh my gosh.
That's a decline of 22% from a year ago. And his quote is, "I'm pleased to share that we've made significant progress in two key challenges. I'm pleased to share that we've made significant progress on two key challenges: selling inventory acquired prior to the shop market dislocation and securing additional capital to strengthen our balance sheet. We're nearing the end of our legacy inventory disposition process, and early results from home sales acquired after September 1st, 2022 are showing positive returns."
Oh. I got a lot to say. We're gonna deep dive this. I'm coming back to this.
Although Offerpad managed to sell 1,865 homes during the fourth quarter, that represented a decline of 23% from a year ago. All right, the whole article goes a little bit deeper into some of those numbers, but before we get that, let's just jump right into the next one, if you don't mind, Daniel.
Opendoor says, "Hold my beer."
Hold on.
Yeah, open my beer is what they said. All right. Opendoor's losses doubled in Q4 as the iBuyer's revenue fell 25%. Just months after a bruising earnings report and major executive shakeup, iBuying giant Opendoor on Thursday revealed that it saw its revenue drop and losses rise yet again in the final months of 2022. In total, Opendoor brought in $2.9 billion in revenue during the fourth quarter of last year. It's pretty good, right?
Not bad.
Compared to the final quarter, that's the newly published earnings report. That's down 25% compared to the final quarter of 2021. Again, as I said during the Compass one, kind of expected because the market has shifted so much. The company also revealed that it sold 7,500 homes, just over, during the quarter. A year-over-year dip of 23%, again expected. Additionally, Opendoor suffered a net loss of, are you ready for this, dude?
Maybe.
I mean, guess. Just guess. I'm already telling you it's more.
I haven't read this one yet.
It's more.
This
Whatever
is
you're
a total
thinking,
net
it's
loss?
more. Suffered a net loss.
I'm going to say 100 million now because you've got me.
Now, remember, this is just between October and December of last year.
Oh, well, that's a full year, right?
No, just October and December of last year.
Oh.
So the fourth quarter, that's it.
Oh, let's go like 25 million then.
You need to sit. Are you sitting down? I can't see.
I am. I happen to be sitting down during our show.
Additionally, Opendoor suffered a net loss of $399 million between October and December of last year. And I'm not altering this article. I literally just, these stats, I copy and paste. I didn't alter this. I didn't accidentally hit a button and add a 9. No, 399 million between October and December of last year. More than double.
Emotional damage.
Dude, seriously emotional damage. That's more than double the 191 million lost from 1 year prior.
More than how much did that said again?
Double. Of the 190, so in the fourth quarter of 2021, they lost in a hot market, they lost 191 million. Now they've doubled it to 399 million. Opendoor lost an average. Ready? Here's where they just said, hold my beer. They lost an average of $28,000 per home it sold in the fourth quarter of last year. That's a stark reversal from the $16,000 in profit it made on average from each home in the sale of homes in the final 3 months of 2021. That is staggering.
I mean, it's got to be game over for these cats.
Dude, that is staggering.
Well, why don't we go ahead and let's jump into the deep dive, because I want to get you guys comments on this. So let's go to the deep dive, Dan.
And there you go.
All right. So what do you guys think? We've got a lot of comments on the Opendoor stuff and the iBuyering, but what about real estate companies? Are they going to be able to weather the storm? People are saying that home buyers should return in the late spring, early summer, but the overall portion of available transactions out there to the average agent just went down a whole lot. So,
right.
So what's happening?
Well,
Matt Lamarche
B
did
has
some numbers. He said the average EXP agent sells $366,000 in volume based on their numbers. It's the average, but when you're a model that takes anyone, the average agent is going to be your average too. So that's not.
That's less than one house for me. My average is $500,000 a house.
Yeah, but I think that Keller Williams probably has a low agent per agent. I'm just estimating because their company,
they have agents that
their company's so big. Anytime your company is huge, you're going to have. Goodness, I can't speak. Anytime your company's big, you're going to have a low per agent production.
Yeah, because there's what is it? The 10% of the agents do 90% of the business.
Yeah. So I'm not surprised by that number, but what's going to happen to all those agents that do sell one house or less per year? I mean, they're going to come out of there, right?
Well, there's no transactions here in California. I've been running the numbers. There's 200,000 agents in California, and there's about 20,000 transactions to go around every month. So there's way too many agents. There's way too many.
I'm looking,
and I think that's the case. Florida has way too many agents. Arkansas was up there, but not as crazy. You guys are pretty level on that. Yeah, I mean,
we don't have a crazy number of agents here compared to other people. We still have a lot for our market, but
yeah, that's what I was saying. You have a lot for your market, but in transactionally, it's closer. You still have more agents than transactions, but it's a lot closer.
Okay, as a tangent, the CEO of Better laid off those people at Zoom in December of 2021. He saw it was coming. Offerpad could have used a guy like him. Good comment, Mike.
Yeah.
So absolutely. A lot of people moved late. And I think, who was it that said we're moving too late to the market? Was it Compass? Somebody started laying people off and they said it was too late, that they should have done that sooner, but they didn't see what the market was going to do. So that's not a bad take, Mike.
Yeah, it's a great, and yeah, however he did it, whatever, the hot take is on how he laid them off, it was in poor taste and done incredibly wrong, but he did it early on.
Yeah. Okay, so where are we going? Where's the market headed? We talked about the pending home sales blowing away in January, and then it's going to be completely failing in February because of the slight increase in rates. The Fed is anticipated to increase rates the next time they meet, March 21st, 22nd. If that happens and mortgage rates go up, then it's going to put a damper on everybody's parade. So what's going to happen to our industry? What's going to happen to the agent? Because you're going to see a lot of YouTubers come out and talk about the crash of real estate. Are we going to see negative valuations?
I mean, it's going to dip into equity that people have built over the last few years. Yeah. But is it going to go, what do you mean by negative? Like under to where we started 3 years ago?
Yeah. No. And then you have a lot of people that move to minor markets that now they have a job change. They just bought last year or the year before. Now they have a job change that they didn't anticipate. And the new CEO says, you're going to have to come into the office. So now they're going to be moving from those, second home markets and everything that they've been used to.
Yeah,
into
yeah.
yeah. I'm going to put the
And
chat overlay up here so that we can see you guys' feedback as you.
for me, I would say the markets that are going to struggle that you will see the biggest declines in, that's going to be like kind of what you're saying, Ray, but where people moved, like people left California and a lot of people went to Idaho and a lot of people went to Texas and Arizona. And now certain markets can sustain that, but in the markets that weren't ready for the amount of money people were bringing from California and they were offering 50, 100, 200 grand over asking, these are now recorded sales. So that's what the values are now. And then other agents are using those sales for their comps and all that stuff. So I don't know if those markets can sustain it, right? They don't have a long enough history of being that high. It's kind of like, in my opinion, when we have an area here in Irvine, California, that's literally new construction on top of new construction for the past 30 years. So there's no real long history, like a 60, 80, 70 year market where you can tell that it's sustainable. You're just comping new construction to relatively new construction. That's a weird thing to me. And then in some areas, you're comping new construction to year-old construction. There's no, 60s and 70s built homes to comp to. It's weird, but I just don't know if those markets are going to be able to sustain that. And then if what happens, like Ray says, they did move to the Idahos in these smaller towns, and all of a sudden now they got to go back to the office. I don't know if those markets are going to sustain it, but will it be a crash of epic proportions like we're going to see on the YouTubes?
So my gut reaction is that those minor markets, as Dusty says, oh wait, Elon says it's time to go back to work. And we've talked about this too in the past, where Yahoo did an experiment. I can't remember the name of their CEO at the time, but they had a CEO that said, hey, you can work from anywhere. They did it for a while. Their productivity decreased. Yeah. And because of the decrease in productivity, they brought everybody back. Now, some said that they were before their time, and now it's a different situation and people can work remotely very efficiently. But I would argue that as productivity is needed more and more, people are going to be asking people to come back into those big offices, the major corporations. Yeah. You're not going to want to report to a guy that's sitting at home in his PJs.
Well, and what if my job is here in California, but I don't want to afford California anymore? So I moved to Little Rock, Arkansas to hang out with my buddy Ray and work remotely, but now I got to go back to the office. What happens?
Yeah, you got to sell. But I think that's going to be great for those markets that are in those second home areas. Like that's going to, if a lot of people did that in our market, because we had a huge influx of people. Yeah. If a lot of people did that in our market, it's going to be really wonderful for the people that are still here. Because they're going to be able to get some great. Matt says no one went to Ohio.
Notice how we never mentioned Ohio.
Columbus, Ohio is actually a major market that people went to. It's the second home. Nebraska, Omaha, Nebraska is another one that a lot of people went to too. So, okay. Anything else happening that you guys want to bring up? Anyone want to jump on Clubhouse? Mike is in the Clubhouse room. Do you want to come up, Mike, and tell us what your thoughts are on this whole thing? Are we going to make it? Is real estate going to be okay?
Well, I've been kind of bearish, if you haven't noticed that, Matt. But I'm thinking the inventory is going to keep us from a major crash. The fact that there's just no new construction, at least where we're at. I mean, there's new construction, but relatively speaking, it's nothing compared to places like Texas or Tennessee where they have a ton of growth.
We don't have. Mike's in California too, I think.
Yeah, I'm down the street from you. I'm in Chino Hills, and Ontario Ranch we have, and then we have, you go further out east.
Yeah, but Ontario Ranch though is one of those places I always talk about. The Melrose and the HOA on that place is insane. It prevents people from overly buying in there, in my opinion.
Yeah, for sure. So we'll see. I'm not as bearish as I was a few months ago. So I think demand is going to weaken, and I think supply is going to kind of buoy that from some kind of major collapse, at least here.
Tell me about the buyer that you just mentioned in the comments on YouTube.
Oh yeah, so I represented them on a purchase back in summer of 21, and actually September. And they bought their house for $1 million. And in March, his employer up in Santa Cruz told him, "Hey, we need you back." They didn't want to do it and put it on the market. They made $125,000 in like 9 months or 6 months, something like that. It was crazy.
Well, would that happen? Would that happen now though? So that was March of 2022. Houses were still kind of cray-cray then. Would that happen now if you took that same home and put it on the market? Would they make as much?
It'd be worth more.
No, they'd probably they'd probably be about 1.8 or 1.08, like 8,000 they would have made.
Interesting. Okay.
So that's that decline.
There was a house on the same street. What's that?
That's the decline that we were talking about at the beginning of the show. The decline in home prices, not values.
Right.
Yeah.
They make money on it, but maybe not as much.
Exactly. They would have done well.
Interesting. Okay. Well, I think the general consensus is that people are still going to come out all right. It could create more affordability in some markets. In other markets that have had a great exodus, like California, maybe it'd be a little bit better for you guys over there.
Still happening. It's still happening here in California. Except for Elon just brought engineering back to California, and he's going to build 600,000 cars a year. But that's beside the point. Anyway, let's bring it back. Let's wrap this up. Let's put a little bow on this. What does this mean for iBuyers with all of these losses? Can they sustain this? Because someone said, I don't know where it was, but I think it was Matt. If you want to scroll back down, I think it was Matt that says that they're not making any money off of homes or selling or buying homes. They're not making any money off that, but they're driving a lot of traffic through their websites. And they're getting revenue from dumb agents.
I think
and mine as well.
I think iBuyering, how they are doing it, is dead. I think a quick cash offer is still very much alive.
Right.
We have a client now.
Like no chance. It's done.
I think
that
iBuying
model that they
dead.
tried to do for a few years is done.
Yeah. I think iBuying is dead. I think quick cash offers very, very much alive.
So they're going to have to pivot.
Yeah. Pivot. Matt LaMarche, do you have something to say? You joined Clubhouse all of a sudden. I feel like you're like, I need to say something to these guys about this. What do you want to say, Matt?
No, I just wanted to see if my face popped up on YouTube. Honestly, that's the only reason
I just put your face on YouTube for you, sir, just so everybody can see.
No, I think Mike's right, actually. And, Atlanta, every real estate professional in Atlanta has all been posting the National Association of Realtors, top 10 list because Atlanta was at the top. And okay, good, fine. But when they say it's one of the top 10 places to watch, it could be for bad reasons. Let's not
right. Yeah, that's what I was going to say.
That good things are going to happen. So, but I'm with Mike. I think everyone's predicting it's going to stay the same in terms of values. We're going to plateau here for a minute or two. But the inventory is actually continuing to go down. So we went up like October, November, December, January. It like doubled from like a month and a half, almost 2 months, to a little over 3 months on average, at least for the last 4 months. But now it's starting to come down again, and it's like, no.
Yeah, ours is dipping again. It's still fine. Compared to 8 days on the market or wherever it was when the hottest point, 12 days on market, it's dipping a little bit, but it's still solid. And then Dusty said it 1,000 times that inventory is slipping in her market in Phoenix.
Yeah. Oops. Sorry.
But I think that's a great point that Mike makes about the inventory kind of, if all of a sudden a bunch of inventory flooded to the market, then maybe you would see some sort of crash. But I don't know if it can happen. It can't.
Too many people have interest rates that are 4 and below. So it's like, they'll just rent if push comes to shove, unless they have a real need for the money.
Yeah.
Yeah. They don't have to sell. I mean, think about the people that locked in at 2.75%.
I'm never selling my house. I'm never selling my house ever. And I don't ever want to pay. I have the option to pay it off faster. I don't want to do that. It's like they're paying me at this point.
Yeah.
Because of inflation. Awesome. Well, thank you guys for joining the show. Really appreciate you miking up on the Clubhouse, jumping into the conversation, adding to the comments. And we would love to hear your comments. If you are watching the replay or joining us late, we want to know, what do you think is going to happen with the housing market? Are we okay? Is it going to crash? If you're a real estate agent, how are you going to make it? Drop a comment. Let us know. And don't forget to follow the show. Subscribe do all the YouTubey things that
Do
people
all the
need to do.
YouTubey things. Is our iBuyers falling out of the market? Is that a bad thing? I don't know if that's a bad thing, right?
I mean, no, I don't think so. I think it's going to be really good for investors. We've always said that the iBuyers are competition for good investors, so I think it's going to be a boon for investors. But
And technically, those big iBuyers are institutional investors, right? Buying up a lot of homes all at once. I mean,
someone by the name of Rodeo Drive said cash offers are very much alive. That's from Clubhouse. So
dude, that's
thanks for
funny.
joining us, Rodeo.
I didn't even read the name like that. That's really funny. Yeah,
It's
Rodeo
a good.
Drive.
So the way they crafted their name was.
Yeah.
All right, Dan. Before we get out of here, why don't you tell everybody where they can find you?
D-Ludwig-Rocks, DLUDWIG-ROCKS, everywhere. Go find me on Instagram. I post dumb stuff there all the time. On YouTube, it's the same, DLUDWIG-ROCKS. Ray, where can they find you?
You can find me on Instagram mainly. Go to Razorback, RAYZORBACK. Send me a DM. Let me know you watch the show. And a special shout out to Kristen Nielsen. I know she's cleaning her house right now. I love hearing how people take in our show. And she's like, every day when I'm cleaning my house, I listen to your show. So thanks for listening to the show. It means a ton to us.
Appreciate you guys.
All right. Bye, everybody.
Bye. Go check on your friends. Tell them you love them. Bye.